Remember, we're still looking at how to manage FX risk, and we've said there are several methods to use, both internal and external method. Internal method, you can issue in local currency, you can do matching and netting, you can as well do lead payment. External method, we said you can use forward transactions, you can use futures, you can use money market edge, swaps, both forex swaps and currency swaps, you can use options as well. Now I'm looking at a question to practice some of those methods, and this question, if you pause the video, take 1 minute to go through the question. This question requires you to apply three methods. The first one is the netting. The second one requires the knowledge of forward contracts, and the third one is the knowledge of money market edge. So, but the requirement wants us to decide whether the company should use a forward or should use a money market edge. Remember, both forward and money market edges are actually external methods. But if you see this question and you realize that you have to do matching first because there's an application of internal method that you can use. And this is due to the fact that there is an account payable of 240,000 due in 3 months, and there's account receivable of the same currency of about $69,000 due at the same time. Yeah, so in that case, you can do the initial internal method, which is matching or netting. In this case, because the external party is involved, so you can call it matching. Yeah, so you have 171,000 net. So this is a net account payable that you need to look for external hedging method. And for us to decide whether the company should use forward contract or money market hedge, this will be based on our attempt to hedge $171,000 and not $240. So this is the amount that we need to hedge because this is what we need to pay net in 3 months that we don't have. How do we go about it? Let's check how much this will equivalent to in our local currency if we use forward contract. Remember, forward contract is about you fixing the future rate at which we do a contract. We need to know our exposure first of all, and we know that our exposure is that we need to buy $171,000 in 3 months. That is what we want to achieve. So if we want to use forward, it means that we need to buy forward for 3 months. So we've been given the quote for 3 months forward here, as you can see it, for dollar and euro as to this. But the question is, which rate are we using? Is it a buy rate or is it a sell rate? And remember the clue that I always tell you, you must always interpret your quotes in bank perspective and second currency perspective, which means you're asking yourself, what is the bank going to do to the second currency? What is the second currency here? Is the base currency, which is the currency at the back. That's 1 in 1 units. And here is euro. Yeah, because what the quote is saying is that bank will buy 0.9520 US dollars for 1 euro and will sell 1 euro for, sorry, let me start again. Bank will buy 1 euro for 0.9520 dollars and will sell 1 euro for 0.9545 US dollars. So if that is the case, if the company needs to buy $171,000, what does that mean for the bank in terms of euro? Let's go through the thought process. If the company wants to buy $171, it means that the company will have to sell pounds to be able to buy that dollar. So now, sorry, we will have to sell euro. And good enough, euro is our second currency. So we get that understanding, right? So the company is selling euro. And if company is selling euro, they must be selling to the bank. Then that means the bank is buying the euro. And in that case, we're able to interpret from the bank perspective and from euro perspective. So if bank is buying euro, definitely the applicable rate that will be used will be 0.9520 1.20, which is the buying rate. So which means this US dollars is equivalent to 1 euro. However, we are interested in 171,000 US dollars to hedge. And that will mean we need to buy, we need to sell, the company will have to sell this amount of euro to be able to buy this amount of dollars from the bank. So, which means the amount that we need in local currency is 179,621 in order for us to use forward. But let's see what money market edge has for us. Remember, the few steps I always tell you to use for money market edge so that you don't get confused and feel like it is complicated. It is not complicated. The first one is always to understand the company's situation, which is the exposure. Yeah. And this time around, the company has a account payable of $171,000. That is the problem that we have. Then we need to create a money market objective to manage that problem. So since we know that this is a liability that we have, remember the money market objective is always the opposite. What does it mean? It means that we need to create an asset that will be exactly 171 US dollars in 3 months. So we're saying we need to create an asset now that will have value equal to 171k in 3 months time. So that is the opposite thing that we need to do. We need to create that asset. That is our objective. That is what we want to achieve. This objective. This is a money market objective. Okay. Now, since we know the money market objective, we need to calculate what is that amount now of asset that will give us 171,000 US dollars in 3 months. The only difference is the fact that we're going to be investing an asset now to be able to get that figure. So we need to know what is our investment rate in US dollar. And if we check that, our investment rate in US dollar will be in this line, not in Australian dollar, not in euro. This is what we need to be looking at. And you know, definitely investment is always at the lower rate because the bank will always want to make money. So the quotes are always from the bank. So bank will allow you to invest with them at 10%, but if you want to borrow money from them, they will give you at 12%. That's what it is saying in US dollars. So which means interest rate is 10%, but 10% is annum 1 year. But we are saying 3 months. So which means the appropriate interest rate will be 3 months rate. And that is 10% divided by 12 times 3 months. And that is the percentage that we are going to be using. And please remember what I always tell you. Rates are always in annual form, except the question categorically tell you to say this is in quarterly rate or monthly rate. But once they are quiet, it means the rates are in annual. So you must break them down into your respective period that you are interested in. Okay, so if that is the interest rate that is applicable for 3 months, and we need to invest now, the principal to invest now that will yield 171 in 3 months definitely will now be equals to that 171,000 that we are looking for divided by 1 plus R. And that will give us the amount that we need to invest now. So which means if we invest $166,000 today at 10% per annum, in 3 months time, it will be 171 US dollars. So we have this information. Now, we are not US company. We are European company based in France. So we don't have US dollars. What does that mean? It means that we need to find euro to sell to be able to buy this amount of dollars. So the question is, how much euro do we need to sell in order to have this amount? We need 166 US dollars. We want to sell euro to be able to buy it. Then we need to ask ourselves, what quote do we need? So amount of euro to sell. We know that if we are selling euro, then definitely bank must be buying euro. So which means this is a buying rate. However, we're talking about now, today. So we're going to be looking at the spot. Remember, your money market edge actually closes foreign exchange on the spot. It doesn't wait to the future. It's current. It's now. What happens while you are waiting for the period time is either investment or borrowing. The exchange itself happens on the spot. So that means our spot rate buying is 0.9830. That's what we're going to use, and that's equivalent to 1 euro. But we are looking for this 166 US dollars. So which means the amount of euro that we will need to sell to be able to have that amount is equals to this divided by can be multiplied. So yeah, because normally if you cross multiply, what you're saying is 166 times 1 divided by 0.983. So which means we need to sell 169,714.41 euro to be able to buy the amount of US dollar that we need. But remember, you don't use excess money for this. In fact, most times question will even tell you, but even if they don't tell you, you need to understand that in money market edge, you're always borrowing and investing. You don't have excess fund. So because you don't have excess fund, it means that we have to borrow that 169. So amount to borrow in local currency is equals to 169,714.41 euro. So that is the amount that we'll have to borrow now. So we borrow that money now. However, this contract is a 3-month contract. So which means to close the money market edge that we're doing, we are going to be borrowing for about 3 months. So there will be interest expense. Nobody's going to borrow us money free. So on that money, there will be interest expense. So we need to check in euro what is the borrowing rate, and it's 13%, as you can see. The bank will borrow money, will give you money at 13%. So if they're going to give you money at 13%, the interest is close to 13%. This is annual rate. Don't forget, divide by 12 times 3 to convert it into what it should be. Then multiply by the principal. The principal is 169 that we're borrowing. And you see that we have additional interest of 5115. So the total euro needed to do this money market hedge is equals to the amount that we borrow principal plus the interest that we paid. And that is the total that we need for money market hedge. Now, if you compare the situation with what you need for forward, definitely you have to conclude that money market hedge is a choice hedge method for this transaction because it requires lower amounts of cash outflow in the local currency. In fact, you'll be saving about, let's see, you'll be saving about this minus this guy. Yeah, that's about 4,000 savings if you use money market edge. And that is it. A quick revision for you on forwards and money market.